subscribers? Welcome back to another episode of Jack the Log Trades. I'm sorry I've been away for 2 weeks, but Kaylin and Sam and Brandon have been keeping it live. So thanks, guys.
Just realized you're wearing a Boring Company hat.
Oh yeah, I got a bunch of these.
Do you have a flamethrower?
I got a. You know what? I actually saw what it was that they made. All they took was a regular torch and like some kind of like bicycle mount, and then just made it look like it was a flamethrower.
Oh, okay. Yeah, because I remember, was it on Joe Rogan's podcast when Elon was saying that it's not technically a flamethrower because flamethrowers are illegal, so it's technically a blowtorch or something weird.
Yeah, he's actually very, very clear about that. He's like very literal. He's like, this is not a flamethrower. This is
It'll be fine.
It even says on the box, not a flamethrower.
That's so funny. Oh man. All right. So yeah, I think you were saying you got a couple messages about people just trying to get into trading and stuff, or they want to like learn how to set up a strategy, or kind of like what was the consensus you were getting from those guys?
Yeah, I was thinking to lean on you this episode to like kind of because I'm not that big of a trader, so then I don't there's some things I couldn't really answer, but in terms of like how refined a strategy you use to enter and exit trades, because what I was being shown, I'm like, the little that I do trade, I'm like, those aren't really actionable instructions, like it's not really a strategy. So I thought it'd be good if you went over like what an actual strategy looks like.
Okay. Yeah, so we'll just dive right into it here because I think we're still being cheap and we're on the free Google, which gives us like an hour to share screen. So,
nice.
So yeah, Sam, if you want to pop over to my screen here, I just have Paint open. So like I'll just go through like just kind of generally what to look for when you're trying to set up a strategy. So it really works both long and short side. Like I know David and I, we have different trading methods. Like Brennan has different trading methods. So first off, to clarify, we're talking about trading here, not investing. So this is like, over a period of minutes, hours, days, up to maybe a few weeks kind of thing is what we're talking about here. So the number one thing when it comes to shorter term trading is the company, I don't want to word this wrong, but the company doesn't really matter that much. And what I mean by that is, if the company has like some new product they're releasing, or there's like some new thing that's going on, or you're worried about what's going to happen in 8 months when they have some merger, like all that stuff is basically irrelevant. So the key things you really want to look for are like for me anyways, and this is what a lot of traders look for. So I'll kind of write them up here is just so you guys can kind of see it. Short float. Short float is really key because that's basically going to tell you like how fast the stock can move in either direction. So basically, 20% is kind of the main, kind of like the threshold, I guess you could say, for traders. So like that means basically, 20% of the float is sold short. And once you get to 20%, that's when it gets riskier on the short side of things. That's when it gets better on the long side of things. So it depends what kind of trade you're looking at. So like if you look, back to GME and AMC and those ones, like the reason everybody was buying into those thinking that it was gonna, go to the moon was because it had, like I think GME was like 100% short float, or whatever it was. AMC was like 30% or whatever it was at the time. So that means that essentially if you get over certain levels where most people are short, they're going to covering creates buying pressure because they're buying those shares back, and then your stock's going to go higher. So if you're a short bias trader, especially if you're beginning, I would recommend, even less than this. Like if you're a new trader, you probably want to look at stuff that's like 10% or less short float. If you're a long bias trader, then the higher the short float, generally the better for your side of things. Another thing you want to look at is the float itself. So this is basically how fast things are going to move, is how you can think of that. So if you're looking at, depending what time frame you're looking at, if you're looking at, say, like on the 1 minute charts, something like that, the smaller the float, the quicker it's going to move. So if you're, I think a general rule of thumb is like, depending how active you can be on your screens, you probably want to go to like a bigger float if you're not going to be involved as long. So like if you're kind of swing trading, or if you're not really able to keep a closer eye on the stock, then it's generally safer to go to a bigger float. But you still want it to be something that's going to move. So Like for me, like my favorite is kind of probably like 50 million or less. That's kind of the range that I like to work in, just because then I know it's going to move pretty quick. I know it's not going to be something that's going to take forever to play out. So
Does
50
market
million or less, like sorry, what did you get there?
do you consider market cap at all? Like have a
Yes.
range?
Yeah, for sure. So that's the next one I look at. So float, if it's 50 million or less, it's going to move. If it's like less than like 10, then you're getting a little bit sketchier on the short side. So you're going to want to give it a lot more range. Like if it's like a 5 million float stock, then you want to give it way more range. And like what I mean by that is, I'll draw some charts here in a minute, but basically you just want to be able to give it a little bit more wiggle room. So like if your stop level is $10, then if it's 100 million float, you could set your stop, say at like $10.15 or $10.20. But if it's a 5 million float or like a 2 million float, you might even need to be willing to let your stop be like over $11, just because they can just flutter around that quick and it'll stop you out without actually breaking the pattern. So that's just something to keep in mind on the short side. Long side, again, is basically the opposite. So I'm writing this all out, basically what to look for me, like if I'm shorting. It's essentially the opposite if you're going long. Like if you're going long and you have like a 2 million float stock that has 30% of short float, then that's great, because you know that there's not a lot of shares and all those shorts are going to get blown out real fast and things going to move like crazy. So yeah, that's the next thing is market cap. So the market cap of the company is basically just like what the company's worth. I like 200 million or less personally. And the reason I like 200 million or less is that basically just tells me that it's kind of a garbage company that's not really necessarily worth a whole lot of money. There's probably not a lot of investors. It's probably in my price range. Like I like to trade stocks that are $10 or less, but like not less than $1, because when you get into the pennies, it's a little too out of my wheelhouse. But yeah, 200 million or less. Again, it kind of goes back to the same thing. Like it's going to be able to move. It's not going to take a huge amount of traders to make the stock give you some range to work with. And then it goes to the same thing. So if the market cap's 200 million, then you're safer on the short side. If it's like 5 million, then it's more kind of a long bias thing. So really it comes down to whatever side you're playing. So you can just kind of look at them like that. What else? Do you look at any of this stuff when you're doing your trades, David? Or
No, but then again, it's almost the same philosophy though. I only trade large caps.
okay,
So I don't think I trade anything below like 20 billion in market cap.
yeah,
Because so then I know the liquidity is there. And then it's a lot safer for swings, like because what you're playing is like crazy volatility in a short period of time, and I'm like, that's the opposite of what I want. I want more stability, more predictability over a longer period of time.
yeah, exactly. So that's what we were just talking about at the start, is that if it's the bigger these numbers are, not the short float, but the bigger the float and the market cap is, generally speaking, the slower the stock's going to move. So like if you are doing, if your plan is that like, oh, I can only look at my charts, once a week kind of thing or whatever, then you probably want to do something that's, it's maybe got like a 300 million float and like a billion market cap or something. Cause then, you're not going to, for the most part, you're not going to wake up one morning and be down 50%. Right. So that's kind of a good point. Institutional.
I've seen how your stocks moved. Like it's like anywhere between like 50 to like 300% within like the morning.
Yeah. Yeah, exactly.
And I maybe
So
for like a 20% over like a few weeks.
yeah.
Yeah.
Yeah, like I mean, even this week, I think we had like SGOC, I think went up like 600% this week. RGC, I think it went up like like a few 100% at least this week. What was another one? NURO, I think was another one, went up a few hundred this week. So like it's common, like it happens, but like that's based on these parameters that I'm writing out here, right? So like this stuff happens all the time. Like if you see like you look at GME or AMC or whatever everybody's talking about, like these it's gone up 500%, 1,000% or whatever. It's not like it happens weekly, like multiple times a week, generally speaking, in small caps. So it's not like a weird occurrence or anything like that. So all you want to do is just sit back and like look at these parameters and learn how to trade them so that you can make money off them. Institutional ownership. Again, this is another big one that I look at. I like it to be like as small as possible. Like, I mean, 20% is probably the max that I like to look for on the short side. Again, institutional ownership, you can basically think of that as essentially, how many people, like how many big investors are in this company, right? So, if you look at it from the long side, if you have like an 80% institutional ownership, that's a really good sign, because that means a lot of people, like a lot of institutions, are buying into the company. They think it's going to go up. Like, it's probably a decent company, generally speaking. So it has less of a chance of like just snapping down and failing and, stopping you out on the long side. So if you have, a really high institutional ownership, that's really good for if you're a long bias trader. If you're a short bias trader, you want really low institutional, like, if you can get like a 0.5% institutional ownership, that's a good sign short side, because you know that none of the big names are investing in this company because it's garbage. So it's probably going to go down. And then what else do I look at? I think that's probably pretty much it. Let me just.
And you run those parameters through your scanner, right?
No, my scanner is basically just based on like volume traded in the day, and then price and the float. But like market cap and institutional ownership, I just use filingspro.com. I'll write that up here.
Right.
Filingspro.com. That's where I find all my information. And like when you go to that website, it literally, like, you type in the ticker name, it literally gives you a snapshot of like all these things listed right there. So it's super quick and easy to sort things out. But yeah, that's basically all I look at is those four things to come up with a consensus for whether or not I'm going to trade it. The next step is, what are you actually looking for in the chart, right? So if you're just starting out and you're trying to figure out, what to look for, or like, what am I going to trade? The best thing that I would say to do is look for things that are moving. Because like, if a stock's not moving, you're not going to make money off it. Like, you don't want to be staring, sitting there staring at Apple when it's consolidating, trying to figure out how to trade that, because there's no trades there. Like, that's just all like algorithms going through. It's just all institutions buying and selling. There's not going to be any really tradable patterns. Like, if you want to find tradable patterns, it has to be retail that's dominating the stock. And basically the way you can tell retail is dominating the stock is it has like significantly above average volume. So you can do this on stocks like Apple or, like Tesla, like David does, obviously, like they're huge companies. But retail, if retail is dominating it, then it'll trade out. Like the patterns will work. So the first thing you want to do is try and figure out, what are your biggest movers? So you could start out by scanning for, today's top percentage movers and just go through a bunch of them, and then today's top losers or whatever the case is. And then you just want to start with a wide net and just kind of narrow your way down. So if you're looking at say I'm a swing trader, like I can only enter and exit trades after hours because of when I'm working. So like I need to find stuff that's, it's going to be a longer term picture. Like I want to find big moves over a few days. And that's what I got to look for. So you'll basically scan for stocks that are moving, and then just start basically what I do is I just start screenshotting them all. Like I think, David, I've shown you my millions of folders that I have. Like I think I probably have, like thousands and thousands and thousands of just photos of stocks that I've saved over the years. Like literally probably like 5,000 or 6,000 images of just chart patterns that I've found, with notes all over them, lines all over them, and everything, just to try and kind of narrow down like which ones are moving. So, we lost you, David.
Could you still hear me?
Yeah.
Yeah, I'm gonna try to deal with this.
Okay.
But yeah, I can hear you.
All right, I'll keep going then.
Yeah.
So yeah, basically, like once you find out what's moving, just start tracking them, and then after you've tracked that, if you're doing swing trading where the patterns might take a week or two to trade out, it's going to take you longer to accumulate like a good level of data to work from. If you're trading like on the day, you can accumulate data pretty quickly. But basically, you just want to keep saving those charts, and then every weekend, or at the end of every month, or whatever the time frame is, just take a few hours, sit down there, and just go through all the pictures. Like, just look at all the pictures back and forth, and you'll start seeing kind of similarities. Like, you'll see like, oh, this one kind of did the same thing as this one, and then you'll pull those two together and put them in a folder. And then when you see that one again, then you start putting that into that folder. And then over time, maybe originally you started with stocks hitting new 52-week highs, and then by the end of that, you have 15 different folders of stocks that broke 52-week highs that did 15 different things when they got to those new highs. And then from that, you try and narrow down, okay, which ones had the best moves, like which ones were the biggest rewards for the least amount of risk. And then you narrow down into that a little bit further. You just kind of keep working your way down until you can get to something that kind of makes sense. And while keeping in mind whatever fundamentals you want to work with. And again, like, these are just the ones that I work with, but you could look at price to earnings ratio. You could look at whatever you want to look at. There's a million different indicators, but you don't want to overcomplicate it too much, in my opinion, because then it just gets messy. Like, I could look at a stock that I know how to trade and find some indicator that completely invalidates what I was planning on doing, just because it's not on the right time frame, or it's not based towards that specific stock or whatever. So keep your indicators minimal, in my opinion, and keep your general parameters somewhat minimal to a degree. Like, if you have 4 or 5 or 6 criteria that a stock has to meet, and it meets all those criteria, generally speaking, you're probably in pretty good shape to take the trade. So if we're looking at an actual chart, you could look at something like this. Hold on. How does this? Oh, that's weird. I don't want that. Hold on here. How do I actually draw on this thing? Oh, pencil. There we go. I don't use this very much. So yeah, if you're looking at a lot of people know chart. You look online and it's like, oh, you have a chart like this, and it's like, oh, it breaks out. So they'll draw their lines. Why is this not showing up here? Is this gonna work?
So the person that messaged me the other day, I was like,
there we go.
I forgot what I should have said was, I can't remember what my answer was, but I should have said, like, and I don't know if you agree or not, but you should, if you're going to start trading, you should have some sort of an edge, right? Because they had like a cookie cutter strategy, and I was like, that's something, but to start with, but you need something more, right? To guys, I guess, enhance your chances of winning.
Yeah. Yeah, and it's like the patterns themselves generally are sound. Like, I just drew this one here as your normal like bull pennant or whatever it's called here, but like you can Google this, you can see it, you can see stocks where it's like, oh yeah, this is a head and shoulders pattern, right? So it's generally a bearish pattern, and then they draw the line there, and they say once it breaks here, then you're going down, and it's going to go down the same height as the head, right? So that's how a head and shoulders pattern generally works. But it's like, okay, like what happens if I like just change the color here? Like, what happens if I get in down here and then the stock reverses and now it's up here and then it's up here? Like, you're going, oh shit, like, well, this isn't working. What's going on, right? So maybe it's because the float wasn't the right amount of float, or the short float was really, really high. So when it dipped down, it squeezed the shorts, and now it's coming back up. Or maybe it's just coming up to test the level, and now it's coming down, right? So just looking at these patterns online, like, it can be helpful for sure, but it's not like, they're never this clean. Like, they're never ever that clean. So you got to basically you have to just learn how to give yourself the appropriate amount of risk. So one of my favorite patterns is basically, essentially it's, you get a long, like however many days of an uptrend, and then we break that uptrend line, and then I'll short the next pot, because as soon as that uptrend line is broken, then that the momentum is shifted. That the shorts are now in control. Longs have started to sell. So like, just if I'm just going to kind of draw like an arbitrary thing, like maybe it's something like this, whatever the stock's doing, and then you can go. This works. Why this line is not showing up?
Paint's weird. I don't know what's wrong with Microsoft. They can't
Yeah,
code to save their life.
All right, Microsoft Paint's terrible, so it's going to be a really bad line, but that's supposed to be a straight line. So let's say that's your uptrend line there, right? And here's your stock. So it's doing its thing, this can be over a period of weeks or days or minutes or whatever your time frame is, right? And then basically, you get to a point where all of a sudden, the stock breaks that line. And basically right when it breaks that line there, I don't know if I draw that in red, right when it breaks that line right here, that's like my first indicator, like, okay, we've shifted momentum, like longs are going to start to sell. And so the next thing that I look at is I want to start looking to short pop. So like what I might do depending on the setup is, I might put on a little piece here, and then it might just tank right down, and then I just cover right into, say, like this level right here. And that might be it. Like I might only get like, maybe an eighth of my size on or something like that. The other thing that you want to keep in mind here.
You know what that chart looked like? If you, I don't know if you can pull it up, but that looked almost exactly like Ford. Remember we were talking about shorting like 15.
Yeah, we were talking about that. Yeah. Yeah. Well, it's like Intel. Like it was the same kind of thing. That's why I shorted Intel, right?
Yeah, yeah.
But yeah, so like if you get like a big break, if you get a break below, like far below a top, and again, this works on the flip side, like the long side as well. I'm just talking short side because that's kind of my specialty. Sometimes you can get a chart where it kind of goes like this, and you don't get a little clean break right there where it goes under that line, right? Where there's kind of like a short top. You might get something like this where you get this huge ramp up here, and then it comes down like that. So now you're looking, right there is your break. And it's like, this could be, say, $15 a share, and down here could be, say, $8 a share, right? So, okay, it's broken the line, let's get in here, but now all of a sudden it does this. Now what do you do, right? Like now you're going, oh shit, like I'm way underwater here. So this is where sizing comes in really important, is you have to draw like the levels where a stock breaks and the level where a stock breaks out are key levels. So anytime any level of consolidation all the way up or all the way down are really important. So like on this particular setup here, like I'd be looking at that level right here. Like this one right here would be basically the last time it showed any level of support. So if I'm getting in down here, yes, it's under the backside line, but I have to size in appropriately to allow the stock to get up to here, because my risk on this setup would be over this previous high. So like I'd be risking, $15 getting in at, say, $8 down here. So that's why I'm saying, like you don't just want to be like, okay, it broke the line. That's what these Google images are saying. Let's get in full size here, because, I might be trying to cover just down into this low right here, which say is, $6, right? So like I'm looking to make $2 on this, and it's going to go up, like $7 or $8 or whatever it's going to go up, right? So I might just put on, if you're going to take, say it's going to be 1,000 share trade or something like that, I might put on 100 right here. And then if it just tanks straight down, okay, great, I made $200, right? But if it goes back up, then that's even better, because now I can add, and then I can maybe add a little bit here. Like maybe there was, maybe it kind of had a small bounce right there. So I can add a little bit right here, and then it keeps going through. And then I can add full size up here. And then it might turn right back around and, bounce down, and then I hit my level, and then I'm out, right? But you always have to be willing to let it go up to that previous level, because if you're not, then you're going to get, like, you're just going to get blown out, because you'll look at it and say, okay, well, this is a normal pattern that I see online all the time. And they say, if it goes back over, like once it breaks here, then if it goes over this level here, then you cut your loss, because that means that the pattern's reclaimed. Well, no, it hasn't. Like the pattern's still broken. It's gotten over the main line, but this is your level. Like that's why I like horizontal lines. Horizontal lines always hold more weight than like diagonal lines, always. So this gives you the indication that the trend has shifted. And what this tells me is, okay, it's shifted to the point where now shorts are going to be sizing into this. So I know all the way up this spike, shorts are going to be sizing in. Longs are going to be starting to sell, because there's still buyers up here. Like there's still buyers right up at this top. And if it gets back to that level, they're all going to be thinking, thank God, I was down 50%. Now I can get out for break even. So they're all going to sell, shorts are going to size in, and then you're going to get that move down. But if you don't size into the trade correctly, you could get in down here and you could cover it at 15 and take a huge loss, and then it plays out exactly how you want it to. So that's why it's really important to get into positions in the correct way. And the same thing for sizing out, right? So like if I was in full size now here up at 15, and there was this little bounce, say here down at, I don't know, say 11 at this line, like I'd cover some right here. I'd cover a piece right there. And then I'd cover another piece on this uptrend line again. And then I'd cover another piece down at this base. And then I'd cover my last piece down here at this base right here, which was my overall goal. So because it could easily hit any one of these levels in reverse. So if you're not covering into those levels, if you're just holding for the fences and hoping it's going to go all the way down, what if it comes within 20 cents of this line and then it just reverses and blows you right out, right? So it's always really good to size in and size out slowly. And, it's just like, a lot of guys just call it line to line, right? Like you draw your levels and you size in on those levels appropriately, and then you size out on those levels appropriately. And then you can take bounces too, right? So if you have a situation like that where the stocks, it's gone way up and you get this big run up and then it tanks, there's your line again. So you start sizing in here, and then, maybe you covered some on this line right here. So I covered some there, and then, it comes down and then it bounces back up, and then we're back into this line. So I can short more here. And then when it comes down, I can cover into this one. And then if it bounces again, I can short again and then cover again. And then if it goes down further, then, maybe it comes down to this level, and then I can cover more down there. And then if it bounces again, it's bounced back up into this line. So I can short more here. And then, you just kind of keep recycling your shares in and out to each line, like each level. You don't, if you're trying to just get in full size and swing for the fences, like you're always going to lose, because generally speaking, the probability of a trade going like perfectly to your entry and perfectly to your exit is pretty low. So if you're not taking profits on the way through, you're not adding on pops or, adding on dips. If you're long side, selling into spikes, you're kind of just, you're just opening yourself up to a lot of problems, in my opinion.
Yeah, it's because of you that I learned that I forced myself to size in and out more.
Yeah.
Because I was actively trying to do like the perfect in and out.
Yeah.
But
yeah, it works out pretty well. Like, and really what it comes down to is just you just want to find out a good setup that's consistent, and the way that you do that is through a lot of research. Like the number one reason that a lot of traders, I think, fail is because they have this image in their mind of like the perfect setup, and they see it and then they'll take the trade and then it fails, and then they'll see it again and they take the trade and it fails, and they'll see it again and they take the trade and it fails. And it's like, why does this keep happening? Like, why is this not working? And it could be because, you're not trading the right float. You're not trading the right stock. You're not in the right market. Like maybe you're trading biotech and that only really works in, tech stocks, but the only way that you know that based on your specific, like I could teach anyone how to trade the way I trade, perfectly, because I know where my patterns work. I know what stocks they work on. I know the criteria that they work on, but that's not to say that I could do the same thing on, Tesla, like you do, David, or I could do it on, Amazon, or I could do it on Apple or any of those other stocks. It might not work. It might work, but maybe not, right? So there's so many different trading styles. So when you're looking online and you're just saying, oh yeah, this is a pattern, so this just works. It doesn't work like that. It might work based on certain criteria. So if you see, like we talked about a bull flag there at the beginning, if you see like a bull flag, which is, basically, you get something like that and then it breaks out. So if you see a bull flag, that might work great under certain criteria, but under other criteria, you might get something like this where it just goes like that, right? Like that could happen too. And then all of a sudden you've jumped in full size right here, and then you just get blown right out. Like that happens a lot. So if you're not, and the reason for that could be a million different things. It could be that, an unforeseen news article came out, which you can't really plan for, and then, that happens. Or it could be that maybe there was too high of a short float, or it could be that there was like something going on with the I don't know, with the market cap was too big, or like what it could be a bunch of different fundamental things that are the reason it doesn't work. It could even just be that the volume wasn't that big, right? Like, and that's why I say, like, you want retail traders to be involved. So if you look at like a blue chip company, like something like Apple or Microsoft or whatever, that has a really high float. I don't know, like, do you know offhand what like Apple trades on a normal day, volume wise, million?
Um, 40, 50 million
Is that
shares.
it? Yeah. Okay. So for example, let's say we have something like this where you're forming this bull flag, and then we break out here. So we have 2 days, two green days right here where it's broken out, but the volume hasn't gone over 40 million, which is the normal trading volume for Apple. So that tells me that this isn't a significant move, because that's still just the normal institutional traders just going about their thing. Retail hasn't jumped on board and started piling in. So that's when I know that this thing can fail, because there's no attention on it. Like, if you look at the volume and the volume hasn't changed when it's broken a key level, there's no attention, there's no force behind it that's going to drive it up. So that becomes a failed trade. So that's that could be the only reason why this trade didn't work. Whereas if it broke out there, and then you have your volume over here, say 40 million daily, and then all of a sudden we have 2 days out here where it's broken through and it's 300 million, then this thing could just rip right up massively, and it could be a huge trade.
It's funny. Did you know Apple had a pennant? They formed a pennant.
Oh
Because
yeah.
it's funny that you called it, because I'm just checking out Apple
Oh
right
yeah.
now.
No, I traded that. Yeah, that's why.
Yeah, I was like,
Yeah.
yeah, it formed a pennant, but it looks like it was a failed breakout.
Yeah, well, I think that was something to do with the options though, because it got up to 150 a couple times, and then
Yeah, I
it
see
pushed
that.
through, and there was like, I don't know what was going on, but there was something going on in the options market. So like, I'm in Apple like long term, obviously, so I'm not really like, I'm not trading it. I just kind of, I looked for an entry, and I'm thinking, okay, if it gets through this, it's just going to go. But if it doesn't go, I'm not too worried about it, because I'm not selling it anyways. Um,
Yeah, I noticed a lot of the large caps actually every so often they actually have very similar patterns, especially on the daily.
mhm.
Because I think they're all affected by the larger market trends.
Right.
So yeah, because I'm thinking if I pull up like a Google, no, well, Google broke out.
Yeah,
Wow.
is that Apple there?
Are you see my screen?
Yeah.
Oh yeah. Oh, okay, there you go. I was like, I wasn't sharing screen.
Is that Apple? Yeah, that's Apple there.
Yeah, that's
But
Apple.
yeah,
Yeah.
like if you were to draw lines on that pennant right there, like there was a failed breakout and a failed breakdown,
Yeah.
right?
Yep.
But if you look at the volume, like you had a little bit of a volume increase when it was trying to break out, but it wasn't anything significant,
No, and it looks like it was still trending downwards over time.
right? So that would drive you nuts, because the thing would break out and then you'd buy it, and then it had a false breakdown right afterwards. So you literally would have bought dead top and sold dead bottom, and now it's come back up again and consolidating. So that's a great example, because people would look at that and they would lose their mind, saying, like, this pattern doesn't work, like this doesn't make any sense. But it's not the pattern, it's just because the volume wasn't there, or there was something else going on, right? So that's why you got to dig into these things. It takes a long time. Like for me, like when I try to come up with like a new trading strategy, like it takes me probably at least like probably 3 or 4 months before I have enough data generally that I'm fairly comfortable taking small trades, and then probably another 3 months after that before I'm willing to get up to any kind of like decent size on it. Like it's usually like I'm pretty cautious when I trade, generally speaking, but like yeah, it's probably like at least like from the time I see something to the time I might actually put it into practice is usually like 5 or 6 months.
Yeah, see, I think goes back to what we were saying is important, is like having an edge, right? It takes like what, a day to learn, the most common patterns. That's not an edge, right? Those are like really basic tools. I mean, so like for Bitcoin, that was basically the last real trade I did, where Bitcoin bottomed with I think it was on 28,000, whatever it was, right? And I
Yeah.
played that. And my edge was not only that I saw a pattern that I still to this day haven't seen anybody else call out, which was a fulcrum bottom. And not only that, but I also pay for the data from Glassnode, so I could see the on-chain analytics. I could see accounts accumulating Bitcoin, like OG accounts. So I'm like, so that's my edge, right? That extra information.
Yeah. Yeah. Can you actually pull that up for a second? That's a great example. I just want to go over it.
Yeah.
Yeah, if you have that handy. Not like your trade specifically, just like the Bitcoin on the daily.
Yeah, totally. Sam, sure. I'm gonna share screen.
Okay. You can pull up mine first if you want, Sam, if that's easier. I can just kind of draw. Yeah, so I'll just draw like generally what happened, and then we can look at it on the actual Bitcoin chart. So, basically we roughly had like a head and shoulders, whatever was going on. So we had, I think it was kind of something like this. We had like this big head and shoulders, and then it kind of came down, and then we had a few bottoms. And basically, this is a great example of essentially a failed head and shoulders, because what happened, and this is why it's really key to think of both sides of every trade. Like if you're a short trader, you should, every time you get in a trade, you should be thinking, how fucked are longs?
Exactly.
Because that's how you know it's going to be a good short, or vice versa, right? Like, our short's getting screwed right now, then I'll go long. So this was a great example, because I actually traded this one short and I lost, but my loss was insignificant because it hit my risk and I stopped out. And then David did the exact opposite. He got in long and he made a ton of money, right? So essentially what happened was, we had this base here on the head and shoulders, and we broke through that level. So, I actually started short up here a little bit because I could see the pattern building, and my risk was the top of this because it has to be, right? Like that's where you have to risk to. So when it came down, we got a pretty quick reversal, and then it came back up. And like my thinking short side was, I want to see this thing, like, just because I know it's Bitcoin, I was like, I want to see this thing kind of, play out before I add more. So I only had like, maybe a quarter total size on this thing. And then what happened was it ended up coming up and it broke over this top, which is where I stopped out. Yeah. So I stopped out right there, and then it came down, and then we had a huge move back up right after that. So if you want to look at this as far as like the psychology behind it, what happened here? So if I'm a short trader, I know that I need to stop out. If I'm a long trader, I look at this and I go, okay, so this thing just broke. It's a perfect head and shoulders. Everybody is piling in short here, and now all of a sudden we've reclaimed. So if we're up in this kind of area here, like the shorts are probably starting to sweat a little bit. If we're up here, anybody who's smart on the short side should be out already. Like I was already out at this point. I'm not trying to say that I'm a genius or anything, but I was already out at this point. But a lot of people don't, right? They panic because they might have been in full size down here, and now they're going, shit, I hope this thing just turns around. So they're all hanging on, just hoping and holding, which is a terrible strategy. And then we get this little bounce, and it just rips up after that because all the shorts were getting blown out through this move, and all the longs are buying into that. So that's a perfect example of how you can look at both sides of the trade to profit. Like, in another, and I've done this a few times where I'll cover my short, David, I've sent you a million of these charts. Like I'll cover my short and I immediately just buy in long, and I end up overall still making money because my loss on the short was small because I sized appropriately. And then my profit on the long was big because I know, generally speaking, if I get stopped out of a short, most of the time it's a long because I know how to trade my setups. I know how to trade them very well. So if I get stopped out, then I know a ton of shorts are getting stopped out, which means it's usually a good time to buy.
I think you just touched on something that's super important. It's your setups, right? If somebody's implementing somebody else's strategy, if it goes against them, they're going to start questioning a whole bunch of stuff and they're not going to have any answers, right? Whereas
Yeah.
it's your strategy, you know exactly how it's supposed to play out, and so you can mark the moment that it goes against you. Like that's it. It's flipped.
Yeah. Yeah, exactly. Like I've literally had times where, I see the stock moving or whatever, and like it'll hit my stop, and I immediately just mark it by 1,000 shares long without even thinking about it, because I know it's broken that level and it's reclaimed, and then I'll wrap it up. So Yeah, it's really important like that to think of both sides of the trade always, because if you're not, then you're basically handicapping yourself to 50% of the information, right? And yeah, same thing. It works both sides, right? If you get a long trade, if you have something like this again, you have something building and building and building. Maybe it's creating like some sort of a wedge or whatever, and then you have this big break up like that, and then all of a sudden it comes back down, and then it comes below that line, and you get a bounce here. Well, that's a great short entry right there, because now all these guys that chase this thing long, especially if there's volume on this, are going to be panicking. And then when this comes down, once it breaks that base, once it breaks there, then you're going to get absolute panic and the thing's just going to tank. And that's exactly what we saw up here on the long side with Bitcoin.
It's funny. Your description of what happened, like that was just purely based on experience, right? You looked at the chart, you looked at the price action, you're like, that's exactly what happened. The funny thing is, I have the on-chain data, and I can see the accounts. I can actually prove that you're absolutely right on everything that you were saying there. When everybody was anticipating Bitcoin was going to hit like 20,000, 25,000, that breakdown, I saw shorts pile in. You could see the accounts pile in and take positions. But those dumbasses, what they didn't do was cover once Bitcoin hit 28,000. They
Oh,
added
really?
more. They added more.
Mm,
And then the thing that screwed them was that somebody was in that area buying it up. So as they were selling, somebody was just absorbing all of that.
right.
And then they were done selling, and then they're like, "Holy shit, we're stuck at 30,000."
Yeah.
Right?
And then when it goes up, it just becomes an easy play. Yeah.
Yeah. I remember I posted on Instagram, like, if I said those exact things. I'm like, if anybody was going to engineer a short squeeze, like, this would be it. And then
Yeah.
what happened? It just went boom.
Yeah. No, that was a perfect example of that. And yeah, that's what it's just so funny because you just got to be able to look at a chart like we can now because we've seen it so many times, but like when you can look at a chart and you can see the panic on the other team's eyes through the chart, that's when you're good. Like I think probably one of the most important things as a trader is to be able to see which side is winning. Like once you can see which side is in control, then at that point basically all you're doing is riding a trend, right?
Yeah.
So
Yeah.
it just becomes it's a really valuable skill to have. But that's not something that I don't think like none of the guys that I've learned from anyways have really talked about that. I haven't, to be honest. Like I'm sure there's some traders that talk like that a lot, but I've never heard any that really stress the importance of that. But to me I think that's probably one of the most important things in trading is to be able to see both sides and really be able to objectively, we always talk about this with everything is like, there's not a lot of objective people out there. Like you can't be married to an idea. Like I don't get into a stock and I think, oh, well, so and so said it's a long, but I'm short. So I'm just going to keep adding, even though it's going way against me. Like I know I'm right. Like, no, like I'll sit here and I'll argue with you for an hour about how I'm right on this stock and it's going down. And you could call me an idiot. And I'll say, no, you don't know what you're talking about. And then if it hits my stop, instantly I could be like, yeah, you're right, bro. Sorry. But it saves you a lot of money.
I think that's exactly where the famous what's that saying came around. It's like the market can stay irrational longer than you could stay liquid.
Yeah, or the market can stay irrational longer than you can stay solvent, right?
Yeah, so it's because like you think the market should do this one thing, and you're gonna be stubborn about it and keep like thinking it's gonna go that way and bet that way, and it's gonna fuck you over time
Yeah,
and over again.
yeah. And the thing that really causes problems too, especially with new traders, is that even if a pattern is perfect, it can still fail.
Yeah.
Right? So that's a huge thing that I want to stress to people as well is that no trader wins 100% of the time, and the reason for that is like because sometimes the perfect pattern just fails. Like I could find a chart that is just beautiful. It has like everything, all the fundamentals are perfect, the setup is perfect, all the levels are perfect. I could get into it full size and like be so confident that I don't even need to watch it because I know for a fact it's going to do what I want it to, and it just reverses and blows me out and I take a big loss and then it just runs up another 100%, and that happens, right? Like that can happen. So that's really key to keep in mind. And as a new trader, I think that's probably, for me anyways, that was one of the most challenging things to really accept, because you can do all this analysis, you can do all this data hunting and get all these numbers and spreadsheets and everything and think, okay, And then you're sitting there and you're going, okay, like this is it. This stock meets all my criteria. The pattern's there, the fundamentals are there, the volume's there, everything's going to work. And then you hit the trade for the first time after 6 months of research and you lose. And you're just going like, fuck, like what the hell went wrong? You know, and you start, and then you go back to the analysis and you start reanalyzing everything. But to people that do that, because, you know, this, nobody ever told me this when I was doing it, you have to keep in mind that it could have just been that, you know, 5% anomaly of a stock that just doesn't work. Like sometimes they just don't do what they're supposed to. And that's, you know, that's the market. It could have just been one freak buyer that came in out of nowhere and just, you know, blew you out, or one seller, or like whatever happened. Like it could be anything, right? So that's why, you know, I've talked about it before. It's really just a game of probabilities. And the important thing when you're collecting your data as well is to save the ones that don't work. Like I do that as well. So anytime I see a pattern that meets all my criteria and it fails, I save those as well in a different folder, because that'll give me a balance of how many of them actually work. So I might have, you know, over say 3 months, I might have, you know, say 100 in the folder that worked, and I might have, you know, 5 in the folder that didn't work. And then I know that this particular pattern has a 95% success rate, right? Because if you're not saving those charts that fail, then how do you know how effective that pattern really is? Like you could be looking at it and saying, oh, this one broke out and then it failed, and you ignore it. This one broke out and it failed, and then you ignore it. And this one broke out and it went, so you save it. But you might only be looking at the ones that work. So if you're only looking at the ones that work, that particular pattern might only have a 10% success rate. But in your mind, you only have charts saved that are ones where this pattern works. So you're sitting there, you know, pulling your hair out, wondering why it's not working. So it's really important to save the winners and the losers of the setup, because that's going to give you the data that tells you your percentage of this trade working out. And then if it does fail, you can sit there with confidence and say, okay, this is one of the 5% that didn't work, and then move on and hit that trade again the next time, because 95% of the time it's going to work.
So what you just mentioned is actually one of the most common biases people deal with all the time, but it's very rarely called out. It's called survivorship bias, right? So you look at books that claim to know what traits a successful person will have, right? The bias there is you only look at the winners, and then you look at the commonality between the winners, and then you're like, oh, it's these things. But then they never look at the graveyard full of people that tried that had those same attributes and have failed,
Yeah.
right? And so you need to look at the full picture.
Yeah, that's very, very important. And that's something that I've never heard anybody who teaches how to trade stocks say. So I just want to make that like abundantly clear, because that's, I mean, really, like a lot of people say, I shouldn't say that, because a lot of guys will say, you know, take the trade, like find out your setup and, you know, take the trades that fit your criteria, and then, you know, save all of your trades. And then once you've saved all your trades, you know how often this setup works and doesn't work. Well, I don't want to lose money figuring out the probability of a setup, right? I'd rather figure out the probability when I'm not spending any money, and then I know if it's going to work or not. Like there's probably 20 different patterns that I've spent months and months documenting and tracking and saving, that just didn't work. Like they were like, you know, 50-50 odds or something like that. Like, you know, maybe when they did work, like some of them were huge gainers. Like they'd run up, you know, 100% in a few days, but they'd only work like, you know, 30 or 40% of the time. So if you're playing the probabilities game, you know, I can't be everywhere at once. So if I miss one of those trades, then the probability is now not in my favor, because if I'm taking every single trade every single time that pattern shows up, if it's 100% gainer versus like a 20% loser, and it works 50% of the time, then those numbers work out, right? Because you're making 100% profits, and then, you know, you lose 20%, and then you make 100%, and then you lose 20%, because it's a 50-50 whether or not it's going to work. But if you're not taking that trade every single time you see it, you might only end up trading the losers, in which case overall you're not going to make any money on that pattern.
Yeah, that's another fallacy. I love how like that one's the gambler's fallacy, where you flip a coin. It's like
Mhm.
what are the odds? You know, it's a 50-50 when you flip a coin, right? Like what are the odds it's going to go heads? So let's say you flip a coin, shows heads. What are the odds of the next one? The gambler's fallacy comes in is let's say the guy gets 5 straight heads. You're like, the next one's got to be tails. It's got to be. I've got, what are the probability of getting 5 straight heads and not getting a tail? It's still 50-50. That's the
Yeah.
fallacy.
Yeah, every time. And
So
that's what makes it hard, right? Is if you're, if you're trading and you have a setup. That's why I like setups that work like 90% of the time or more, because the odds of me getting, 3 or 4 losing trades in a row is very minimal, but it can still happen, and it does still happen, right? Like I have, like I haven't, like I've gone, I think I've done like 40 trades or something now over the past like 6 weeks, and I've only lost twice because the pattern that I play has I think it's a 93% chance for success. So
okay.
but like I lost 2 trades in a row, right? So if I had started there, I'm like, okay, this pattern works 93% of the time. If I didn't have that data, knowing the percentage of how often this thing actually works, and I was like, okay, I'm going to start trading this pattern now, and I have 2 losers right out of the bat, I'm going to go back to the drawing board and spend another few months trying to figure out what went wrong. Well, nothing went wrong. Like the pattern works. It's just that's the 7% that's going to fail on me, which is fine. But as long as I trade every single one, overall, I'm going to make money on that setup.
Yeah, I think it might be shocking to people to realize that this takes work, like a lot of work.
A lot of fucking work. Like, a lot of work, man. Like I was talking to Brendan the other day, and I was like, yeah, I think I actually said it on the last podcast. I was like, yeah, now that I'm like, I've been trading for like 4 years, and I know what I'm doing, and I can make money. I can enjoy the luxury of only working 16-hour days.
That's legit, man. Like,
Yeah.
you really have to like put in the hours to find like the edge, right? Like I go about it completely different from you. Like I don't save my patterns and whatnot, but I spend probably an equal amount of time looking for other data, right? Yeah, my like, so if it's Bitcoin, it's my on-chain data. If it's my Tesla, I'm like scalping for every piece of information that would affect the company's stock price. So like whatever it is, it's always work, right?
Yeah. And it never ends because things are always changing. Like even though you're in Tesla and Bitcoin, and like you've traded both of those for years, and you probably know like more about them than almost anybody, you still look at them every single day because something can always change. There could be a new variable that pops up, and you got to take that into consideration,
Yeah.
right?
Yeah.
It's the same thing with the way that I trade. Like my patterns work great, but if we go into a bear market, or if we or like you get COVID where everybody's at home and there's this huge flood of retail traders, like they change. So if I'm not like every single day, I track every pattern that I see. Like I spend a couple hours every single night of the week after work going through whatever happened that day, saving everything, writing notes on everything. 2 hours a night every single day, no matter what. I never miss a day. And that allows me to stay current, because then at the end of the week or at the end of the month or whatever your time frame is, like I can sit there at the end of the week and say, okay, like, what was like things seemed kind of weird this week. So like what's going on? And I can look back at the past 3 weeks and I can see a trend. I can see like, okay, like, oh, this is why the stocks weren't going as high, because like things are generally coming down. So like maybe instead of giving the stock this much range, I need to, pull things back, and I need to get in full size a little bit sooner. Or maybe I noticed that things are starting to heat up, so things are going further, and it's like, okay, that's why I maybe took a bigger loss than I wanted to, so now I need to spread those orders out further again. But like if you're not doing that on a daily basis, like if you've just set up your pattern 2 years ago and you're saying, okay, this is it, like this is what I'm going to do, like it fluctuates, it changes, right? If you're in a bull market and you're a long bias trader, you might see a specific setup that every time you see it, it goes up like say 30%, like 20 to 30% every time you see that trade, and it has a 5% like potential for a loss. But then if you get into a bear market or a sideways market, that exact same setup under the same criteria, under the same fundamentals, the same volume, maybe it only goes up 10%, and then it still has that same 5% loss. So it's only going up say 8 to 10% on average. But if that pattern say only had like a 35% success rate, it would have worked great in the bull market, because your upside of 30% and your downside of 5% on average, even if it's only a 30% success rate, you're still making money. But once you get into a bear market where that upside comes way down, that same pattern under those same circumstances does not work anymore.
Yeah, that's when people get chewed up trading when they shouldn't be. Like they get just chopped up.
Mhm.
But it's funny that you say that too, because remember like I think it was last month, I kept complaining like there was like a series of orders that I had that continued to be missed by like 5 cents, 10 cents, like some infuriating number, right? And
Yeah.
it was for exactly the reason that you brought up. The market sentiment does change, and when the sentiment changes, the targets change too, right?
Mhm.
So I hadn't adjusted yet. That was my problem. I was still in the this is a full-on bear market mode. So then I went a little. I'm trying to go long, so then I went a little below where I normally would. I'm like, I think it's going to sell off a little bit harder because the sentiment's a bear market, and that's why I kept missing the 5 and 10 cents because it was actually turning into a bull market, and then so people were like trying to jump the gun, and I didn't make
Yeah.
that adjustment.
Yeah. Yeah. People are buying it up a little bit quicker because everybody's excited.
Yeah, yeah. So
Yeah.
they're front running. Yeah,
Yeah.
it's hilarious
So
how
you
much.
still want to use you'll still use those same levels though, right? Like if you're trying to buy on a dip, like if it's Bitcoin, I don't know how you'd size in, but let's say you're gonna try and size in at like 30,000, 29, and 28,000, like X amount of shares. Then if it's a bear market, you might do, I don't know, say 100 shares at 30, 100 at 29, and like 200 at 28 or something, because you want most of your size at the very bottom. But if you're in a bull market, then you might go say 150 at 30, 150 at 29, and then maybe like 100 at 28, because you still want to have some spread out to that level, but you want to have more a little bit sooner, because that sentiment can change. You might not get that last ad, right?
Yeah. My adjustments are like point 0.5, 0.7%. So like if it so because I'm using the VPBVR to find my levels and the volume price indicator. But then what I do is like let's say if it's a bear market, then I'll add an extra maybe 0.5% on top of what I think it'll be just to front run it a little bit. But then if it's a bear market, then I'll go a little below 0.5%, 0.7%, something like that. And then it works until it doesn't. And so like I need to keep keep my pulse keep my hand on the pulse of the market so I know when things are shifting.
Yeah, usually like the way that I kind of like to do it is like if I have a line, say it's like $10 or something like that, I'll put, instead of putting an order on the line, I'll either do like one just a little bit below it, or I'll do two. I'll do one a decent amount below it, and then I'll do another one over it, depending on the. And that was what I was kind of talking about at the very start. So like if you have a stock with a high short float or a really low float, you need to give it more range, right? So if it's something like that, if it's kind of falling into the, like let's say it's 20% float and it's a 5 million share, or sorry, 20% short float and it's a 5 million float stock. Like if I'm shorting into say the $10 mark, I might put one order at say 10, or sorry, like 960. I might put one at 10, and then I might put one at like 1060 or something like that. Whereas if it was say because that way, if it does get that big wick, then that chunk of orders, my average is $10, which is my line, right? But if it only hits the bottom two, then that's fine. If it only hits the very bottom one, that's fine too. I mean, I won't have as much size as I want on the trade, but I'm still going to make money. But if it's something where it's like, let's say it's got 0% short float, the overall float of the stock is like 50 million, then I might do something where I'll do like instead of 10, or instead of 960, 10 and 1060, I might do like 985, 998, and then like 1010 or something like that, to try and keep those orders a little bit tighter, that line.
I just came to a realization why I do that because I only play large caps. And so like it's weird to split up a $500 stock. If I'm only taking like a $5,000 position, that's 10 shares. That I get split up. You know what I mean? So
Yeah,
it's like,
that's true.
but it
Put
makes
one share here, one share here.
exactly. But it
Yeah.
makes so much sense for you if you're playing like the $10, $20. You could split them up. Like it just feels more easier, like more natural.
Yeah, that's true. Yeah, because like if I'm throwing like a few thousand shares into something, like I could, if it's over, like if my range is $1, I mean,
Yeah,
I could almost do like a few hundred shares every 20 cents, right?
that's
And I'll just
right.
be like,
That's right.
just hit all of them, right?
That's right.
Yeah.
That's funny though. I just realized that just now as we're talking.
Yeah, that makes sense. But to be fair, because that's the way I trade. I have done that. Like like when I do trade like larger companies, I've had ones where I'm like, I'll buy like 3 shares here. Like if I'm trading Amazon or something, it's like, okay, I'm gonna try and buy this dip. I'll do like 3 shares, and then I'll do 2 shares, and then I'll do 1 share. Try and still get like the spread on them.
I salute and respect the consistency, man. That's like awesome. So awesome.
Yeah, I can't get away from it.
Oh man. But so wait, are you still swinging right now?
Like Amazon?
Like any of your positions?
I just have GRA right now as like my long term swing, like Nano Explorer, the Canadian company.
Yeah.
But yeah, like Amazon and like Apple and like Nvidia and all those ones, like those are investments, right? I'm not trading in and out of those. Like those are just kind of my set and forget ones. So I haven't really found any other good stocks that I want to like long term swing trade recently. But like GRA has been great. I've been posting that. Like I've been posting that on my story like a few times, my Instagram story, just try and like show people what I mean by like trading around a core. So it was like, like I got like I'm into it in like the $3, and then it shot up to 460, so I took a little bit off, and then it came down, bought a little bit more, and then it shot up to 550, so I took some off, and then it came back down to 460, so I bought more, and then went back up to 540, so I sold a little bit more. Like just anytime I get any sort of significant move, like I have a few thousand shares of like just my core position, and then I'll trade in and out with 2 to 500 shares sort of thing. So I'm just like I have this like core chunk with a good average, and then I just trade a few hundred shares around it anytime I get a decent move.
What constitutes a significant move for you? Because I've been sort of doing that with Nvidia. I just got out a little bit more. Like I think I've sold 30 shares in the last month because it's all around the $200 mark, and I think it hit like 220 something the other day, and that was one of my levels. So I'm waiting
Yeah.
for it to come back. But like for me, I'm trying to like at least capture 10% moves. I don't know what it's like for you.
Honestly, I don't really look at things like I probably start looking at it more now that I'm like in like more long-term investment stuff. I look at it, but like when I'm trading, I don't look at percentage moves. Like I just looking at the dollar. Like like GRA is like it's at $5 or 5.20 or whatever it's at right now. So like if it moves like 50, 60 cents, like I'll sell some because that's a pretty decent move. I don't know what what the percentage of that would be, but yeah, like I'm just looking at kind of anytime I just like I can just see it, right? Like if I look at the chart and I look at how it's moved, I'm like, okay, that's a pretty aggressive move. I'll take a little bit off, sort of thing. Like it's I don't want to say intuitive, but I guess it's intuitive. But like stuff like Nvidia and things like that, like I'm not selling into pops. I'm only buying dips because it's just like a long term accumulation. Same with like the S&P or any kind of stuff like that I'm just in for the long haul. Like I'm not gonna like if the S&P index shoots up 5%, I'm not gonna sell some. I'll just be like, oh, this is great, and then if it dips 5%, I'll buy more, kind of thing. So
Oh, did you buy the index?
the S&P,
Yeah.
yeah, I've owned that for a long time.
What was it? ETF?
Yeah,
Oh, okay. I didn't know that.
yeah,
Interesting. It's just to park your money, like you didn't want to put into like more into Nvidia or something like that.
yeah. Just like to own like some of the index, like the S&P. I want to own like ideally I want to have like a decent amount of S&P, like some of the Dow, some of the Nasdaq, and then buy some of the foreign indexes as well. Like I want to have a pretty decent amount of all the indexes, like kind of across the globe and any of the good economies.
Oh, you really want to diversify, eh?
Yeah, because it's easier for me, right? Like I mean, like I make most of my money from like shorter term trading, right? Like so that's where the income comes from, and then I can put that into the long term stuff. Like I, to be honest, like I just like because I work full time still, like I just don't have the time to really like do the research on companies and find good companies and do all that kind of stuff like you and Brendan do. So like if you guys tell me like we're talking about a few good companies, like I'll just look at those and do some research and be like, yeah, this is good. I'll hop into it, kind of thing. Or like, no, it's not, and I won't. But like for me to like go out hunting and find my own stuff, I really just don't have the time for it. So it's easier for me right now to just kind of accumulate indexes. Then I know I got my like little dividends and guaranteed my 10% a year or whatever. And yeah, just kind of like just kind of a safe place to be.
Yeah, I think that's a good message to give. Like, because I say it a lot on my messages, but I don't think I say it a lot on the podcast, which is like you need to find the strategy that fits your personality, right? Because otherwise, it'll drive you nuts. Like with money on the line and you're doing something that it's against your nature. It's like it's terrible.
Yeah, It's also a fine line too between like honestly just like having like living because like I mean like I work long days at my full-time job like I do like honestly work 16 to 17-hour days Monday to Friday like I have zero free time. It's like I'm up at 4, I go to work, I come home, I'm like running around the house, I work out, I do my meals, I look at the charts, I get coffee ready for the next morning, and then I'm to bed. Like I don't have time to watch TV or do anything Monday to Friday. So like for me to try and add something on top of that, I mean I'm running on like 6.5 hours sleep on like a good night. So like I really don't have any time in the day to try and add any more into that. And like outside of that, it just becomes exhausting. Like I enjoy trading stocks. Like I enjoy, doing short-term stuff. And like I remember like even with Bitcoin and stuff, like I know you kind of showed me it a bit, but like I did that for like 2 weeks. I was trying to trade it because it was a 24-hour market. And I was like sitting on a Saturday night and I'm like watching it, like trying to trade it. And like the next morning I woke up and I was like, you know what, even if I figure this out, like I just can't, man. Like I need to have that separation where I can like cool off and relax, because if I'm trading something that's 24 hours, like I'll never be able to separate myself from it. I'll just get buried in it, and like to me it just becomes like exhausting and I kind of lose the fun.
Actually, I can fully attest to that. You do get lost in it because I started trading futures really heavily in November all the way into the spring, and it got to the point where I was that's all I was doing with every minute of my free time. And the thing was, I was trading worse and worse because at some point you can't see the forest from the trees, right? I'm just starting to like play shorter and shorter time frames.
Yeah,
Yeah.
because you just want the action, right? Like you want to be in the action, right?
Yeah, it's like the second I'm out, I'm like, I take a breath. I'm like, "Ah, fuck, let's do it. Let's do the next play." But I shouldn't
Yeah,
be doing that.
yeah, because then you're trying to force plays, right? And like that was the thing that I didn't like about Bitcoin personally, is it's like I'll be like sitting there like waiting for something, and I like keep checking my phone, and I'm like, it's not there yet, it's not there yet, and then like I'll go to bed, and then like the play that I've been waiting for happens at 3 in the morning, and it's this huge
Yeah,
move, and I'm like, and then I get pissed off, and I'm trying to look for something the next morning, and it's like I can't do this, man. I need like I need separation on that kind of stuff. So, but I mean, to that respect, like if I was trading like full time, for example, I probably still wouldn't do Bitcoin, but I would be a lot more involved in like the longer swing trades with stuff like the big blue chip companies like Tesla and Xpeng and Neo and Nvidia, or like whatever whatever's moving a lot. I'd probably be a lot more involved in swing trading that. But just for now, like I mean, the way that the way my life is, I just I put most of my money in the indexes. I have one account where it's all kind of not swing trades, but like all my individual investments, and some of my swing trades are in there. And then I have my other account, which is all like my shorter term stuff. So I just kind of keep them separate, and I basically I just do whatever I have time for, essentially.
yeah, I'm the same. I think I don't know if I guess it's the same for you. It's like a mental aid where it's like you compartmentalize your assets. So then these are only for swings. These are only for investing. It just somehow makes it clearer.
Yeah, yeah. Like I have 3 different accounts, and all 3 accounts have different things in them, because it's easier for me to keep it separate. Because then like my long term investments and stuff like that, I'm not like if I'm looking at my swing trades, I'm not pulling that up and seeing that I'm down on one of these stocks, and then I start like, oh, what's going on? Like I don't even look at them, right? Like I look at them like once a month, because I don't like I'm not selling it forever, so I don't really care what it does right now.
Yeah, yeah,
Yeah,
100%.
it's the same thing with like bodybuilding, man. Too. Like you can easily get like just so submerged in it that it becomes like overwhelming. But like I like going to the gym. I like lifting weights. It's like I like trading. I like trading the way that I like to trade. So like I don't want to be a personal trainer, because I don't want to be in the gym all the time, because it sucks the fun out of it for me. Like I don't want to be trading all the time and constantly thinking about it, because it takes the fun out of it.
Yeah, I fully experienced that. Like the soon as actually it was a good experience losing that little bit in springtime in futures and just getting so fed up with the whole thing. And like because now it really made me realize like I really enjoyed longer swings. I like being able to spend like maybe a night doing my research and doing my TA, setting some orders and just forgetting about it. And then I'll look at my phone one day, and be like, oh, look, it hit, you know? I really enjoy that.
Yeah. But that's perfect because then it's fun, right? Like you're making money and you're enjoying it, and that's what it's all about. Because like if you hate trading, you're not going to be a good trader, and you're not going to commit to the kind of effort it takes, right? Like same thing with bodybuilding. If you hate working out and you hate eating, like you're never going to get huge. You know, like you gotta enjoy it, and if you like deliberately suck the fun out of it, then you're just going to get bad at it.
Would you agree that in the beginning you might have to take a little fun out of it just to put in the time and the work to just get a grasp of it? I mean, we're obviously enjoying it now, but we can afford it, right? We have the luxury of all of it.
Yeah, but I mean, like, but yeah, that's the thing too, though. Is like I still enjoyed it. Like even when I was losing and stuff like that for years, I was still enjoying it because it was like like anything I've really done. Like I don't know how to I don't know how to say this without sounding super arrogant, but like anything I've really done, I've usually been pretty good at it. Like like when I used to wakeboard, like I could do it immediately. Like when I raced motocross, like I was top of my class pretty quick. I was racing in high levels. Like when I played hockey, I was really good at that. I got a bunch of awards. Like in school, like I was always getting 80s and 90s and everything. Like I've just always been generally good at anything that I've focused on and I've been interested in. So like when it came to trading, it was just like so frustrating that I couldn't figure it out. But like I just found it so fascinating though, because I was like, this is the weirdest thing ever. Like you just sit here and you just look at these little lines moving around in a screen, and if you know when to buy and sell or short and cover, like you can just make money like sitting at home by yourself. I don't need to like you're not going to work. You don't have employees. Like it was just like this weird fascination with this like such a unique system of making money that I couldn't let it go. So like I was completely obsessed with it. Like I couldn't not think about it. There was months when I was like miserable and frustrated and like depressed and like beating myself up because I was like, I can't figure this stupid thing out. Like this is impossible. But I would always go back to it because I was like, I'm a smart guy. I can figure this out. Like I gotta figure this out. I just wouldn't let myself quit. But it took years of frustration. But the underlying feeling was that like I still loved it. I still love the learning experience. I'm like, why is this working? Why did that not work? Like I'm pissed that I lost money, but I want to figure it out.
Well, I think it probably helped that you were making progress, though. You would make a mistake, you would refine, you make it progress, right? I bet you if it was all losses over a long enough period of time, you'd have been like, "Oh, fuck this thing," right?
Yeah,
But you made progress.
but overall, I wasn't making progress, right? Like for 3 years, I was steadily losing. Like I didn't become like a break-even trader until like after 3 years of trading. So like I
Maybe
was,
maybe
sorry.
not in terms of consistently in the green, but maybe in the terms of like you're starting to refine your pattern. You're starting to understand more. Like those are wins, right?
Yeah,
When things
yeah.
start to click, like because that's what I used. Like I blew up 6 accounts. It wasn't until like maybe the last 18 months that I started making money consistently, but I blew up 6 accounts, and it would be the same story every time. I'd feel disgusted, like fuck this thing, I'm never touching it again. And within like 3 weeks, I'm like, I'm back. I'm just looking. I'm just gonna look.
Yeah. Yeah. So you have to have like some sort of a passion for it because otherwise you're not going to deal with all that, right?
I just saw it as like a puzzle. I'm like, I can't believe there's a whole industry of people, trillions of dollars making money, and I can't figure this fucking thing out. Like that's just
Yeah.
unacceptable.
Yeah. I was the exact same way, man. It's frustrating. You're like, why? Like you feel like an idiot. You're like, I refuse to let myself fail at this. Like I'm not going to look back 10 years from now and be like, yeah, I tried that thing and I quit because it's like, it's like with bodybuilding, right? Like you get up on stage, you go to do a show. Like in my head, I was like, even if I lose, as long as I know I did everything right, the whole prep, I didn't miss a beat. Like I can lose and still be happy with how I presented myself. It's the same thing with it's just the same thing with me for anything, right? Like I can't like something that I'm interested in, like I can't look back on it and be like I gave up. Like I have to look back on it and be like I literally could not have physically done anything else to be better at that thing than I was. And that's what I did for years is I was doing every single possible thing that I could think to get better at trading until I finally figured it out. And it took years.
I get it. I get it. It's like you don't want to be the one that says stop. You want this thing to tell you stop. You suck.
Yeah, yeah, basically. Like if I
Yeah.
just exhausted all my options and I still kept losing, then that would have been fine. But like there was always little breaths of hope in there. So I
Yeah.
was like, okay, like this is possible. I just got to figure it out.
Wasn't that the most frustrating period when you just learned enough TA where shit kind of makes sense, but you couldn't make it into you couldn't put into practice, like it wasn't consistently working. It's just like,
Yeah.
what am I missing? What the fuck am I missing?
Yeah, it drives you nuts. And it's like you have all this data and it's like you go into a trade, but like, you still don't really have any confidence in yourself. So you're taking trades and you're getting in so small and then you're giving yourself like no wiggle room for a loss and you're taking a loss and then like if it goes up like the tiniest bit, you're like, oh, I was gonna sell it up here, but it's green, so I'm just gonna take the money, and then you just get out and it goes way up afterwards. And it's like it just becomes like this frustrating thing. That's why like confidence becomes so important because like once you're confident, you can let it go against you as long as you know the setup's going to work. But yeah, that was like a pretty much like a year of my trading career as well, was just sitting there and just being so unconfident like in every single trade I took because I'd have all this data and like I'd sit there on the weekend and be like, yeah, this is perfect. Like I'm going to be making millions like next week. This is great. I have so much information. And then I go to take the trade and I'd just be sitting there like sweating buckets, like trying to like, see if it's going to work. And I'll be risking like $20 or something like that. And it's just like, it's like a life and death situation.
It's not the money. It's not losing the money. It's like being
No.
wrong. That's
Yeah.
what hurts.
Yeah, exactly. Exactly. That was the most frustrating part, is just being wrong. Like I didn't even care about the money. It's just like, I put all this time into it. That's the funny thing about trading. I've heard some guys talk about it. Like, it's not like you put in 2 hours last night. So it's like, oh, I should be getting, $30 an hour for my time. So like I should make $60 today. It's like, it doesn't work like that, right?
It's you know what it is? It's almost getting comfortable knowing that you don't know everything and that stuff's just going to work against you. It's inevitable. And then within those variables, like how do you do this?
Yeah. That's why it's such an impossible thing, is because everybody like it's against everything that of human nature. Like
Yeah.
it's like, you have to sit there and be like, okay, like, yeah, this is like, I gotta be comfortable putting all my money on the line. And at the same time, I'm totally prepared to take a loss on this because it can happen. Like, it's a really weird mindset you gotta be in.
Remember a few months ago I sent you, it was like on WhatsApp, it was like that meme, it was like Jon Snow, he's got the sword out and he's getting rushed by a horde and he's standing all by himself.
Yeah.
That's exactly what I feel like when I'm catching a knife, but that's
Yeah.
exactly it. It's like I have to live with the fact that everybody says I'm wrong, but I'm saying I'm right, and let's do this. Like we're gonna put money on
Yeah.
the table. Let's do
Yeah.
this.
I love it though. It's such a good feeling. Like you're looking at it, everyone's like, "Oh, this thing's gonna spike." It's like, "Oh, it's ripping up. Look at it go!" And blah blah blah. And I'm like sitting there, and it goes higher, and it's like hitting my shorts and hitting my shorts, and I'm just sitting there, and I'm like, "All right, like let's see what happens." And then it turns around, and I'm just like, "Yeah,
Yeah,
it's a good feeling."
that's good. I think this was an awesome episode.
Yeah, I think there's a
Um,
lot of good pointers in there. A lot of stuff that I didn't know. Hopefully, some people learn some stuff that helps them make some money. And
yeah, I realized some stuff too, but I think next week's will be interesting because if it's just funny how that worked out. Today we fully covered trading once again, and the next week we're going to cover investing with Brendan.
mhm,
I want to talk about because I think this is one topic we haven't been touching on in terms of investing, which is let's say you don't want to manage your own money, but you want to be involved in the market, then you're probably going to need a money manager, buy a mutual fund, and like so it's like important to know how to pick this individual.
yeah, yeah, that's a really important thing. I'd like to learn about that too, to be honest.
Because I personally have nothing but sour experiences. When I was at Brinks, they came to us with a plan. They're like, we'll match whatever your contribution is. There's literally only four plans, like low risk, higher risk, slightly higher risk, and highest risk, right? But I'm looking at what assets are in there. I'm like, this is basically the same shit, just different proportions. It's all like safe shit, right? And the 3 years that I was there, not only could I not beat inflation, I actually lost money because of the fucking management fee.
Mhm.
So that's what drove me to like manage my own money. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in January. And then I took over my mom's RSP in Ja but she's also got two other products that somebody at TD sold her. And I looked at it, man, they did 18% return over 10 years. One was 18%, one was like 16 and change. And this is after last year's monstrous run. I bet you it was negative, like without last year.
Yeah, that's pretty bad.
Like, and the thing is, like, so I don't think most people know, it's like those financial advisors that work for a bank, they get commissions selling those packages to clients, and they don't
Yeah.
really care whether or not it helps you. That they got their commission.
Well, I think that's a bigger problem in the States too. I think with 401ks more so than it is here with like RSPs. Like 401ks, there's so many different money managers out there, and it's like it's a really, I don't want to say sketchy, but it's like a lot. There's a lot more moving parts going on. It's a lot easier to make the wrong decisions. So yeah,
Ah,
yeah, let's talk to Brandon about that one because he probably has a lot more insight in that than we do.
because on Tuesday was it Tuesday or Wednesday, I spent like an hour chatting with somebody about it, because they're like they said something that made me mad. I think that's why I spent an hour with them. Because they're like, they went to a bank and they wanted to talk to a money manager, and like they basically made this person feel stupid, just like, you don't know what you're doing, let us manage it because this is way beyond you, kind of thing. And that just made me mad. I'm like,
Yeah, yeah, a lot of people do that, right? They try and take advantage of you. So it's
yeah.
tough though, right? I mean, if you don't have the time or you don't really have the the willingness to try and learn how to do it. I mean, like to be honest, like I don't like I don't know what my future investing career is going to hold. Like, I might just keep buying indexes and I might just keep trading, right? Like, I don't know. Like, because I haven't really dove in like to the long-term stock picking investing like you and Brendan have. Like, I might just not like it. I might just not be good at it. I might not care to put in the time to do it because I've never really dove into that. So like, it's not necessarily that I don't know how to do it. It's just like it just can't hold my interest enough to make it profitable for me. And if that's the case, then I'll probably just look for a good fund manager and then have my own accounts where I can put money in indexes. Just leave it at that.
Really, you would find a manager even if you were just going to put it in an index or something?
Yeah, like I like to I just always like to spread stuff out, right? Like I said, I have three different accounts. Like I do all different types of trading, like all different types of companies, and yeah, I don't like having all my stuff in one spot. So
Right. Because I agreed. Like, you probably, I was thinking that you probably don't need to go into full on investing. I figured you'd just be making a chunk of your money consistently with the trading, and then whatever cash you have left over, you just kind of park it in some, high yield assets, right? Or like
yeah,
the S&P 500 and something with like a dividend.
yeah. Well, that's like what a lot of like a lot. It's funny. A lot of the long or like the shorter term traders and stuff that I follow, like a good chunk of them, basically what they do is they put all their money into indexes and then they buy real estate with the rest of it because they're you're making like 500,000 $1 million a year doing short term trading. I mean, if you're making that kind of money, it's just an easy, like it's an easy, relaxing way to just put it in the indexes because like it's it can be a pretty stressful job doing short term trading too. So if you're trying to add on, looking into all these companies, digging around, doing all this other research, which really is a completely different discipline than what I do. A lot of the guys, they just don't like it. They need that time away from the screens to be with their family and live a little bit and kind of enjoy their lives. So it's just it just works a little bit better to just put that money in the indexes, buy real estate, and then you have your dividend money, you have long-term growth. If you can put like a few $100,000 every year into good indexes, I mean, like that's fine. You can make a ton of money on that, really good return, and that's basically just like long-term investment. That's retirement fund, right? And then your short-term trading is your spending money. It's your daily money, and that's like that's enough. So it just depends. It just depends on what you're interested in and what makes sense for you can't work yourself to death too, right? Like you got to try and find a bit of a balance. Like I mean, coming from a guy who works 16-hour days, like I still I take Saturdays off. I don't do anything on Saturdays, but then I work all day Sunday again.
You know what? That's a mark of a good trader, though. They realize what they're good at. They're going to do that and put all their energy into that, and then they probably realize they're not going to be good at investing. So let's park into real estate, which I think is genius. Like, you have that chunk of money, put it to work. But because I think if they try to invest, maybe it goes south. It goes the other way, and it's like, you're making money this one end and you're losing it the other end. So it's like, what's the point, right?
Yeah. I think it's just a patience thing too. It's like a personality thing. Like I like to be in and out of stuff, like, you know, relatively speaking, fairly quick. Like I'm okay with like long-term stuff because like I'm doing my other short-term stuff at the same time. But like if I was actively finding long-term stuff by myself, I don't think that I would be quite as patient with it. It's because I have you and Brendan to kind of back up those decisions. That makes it a little bit easier for me to kind of ignore them and be comfortable with them. But like right now, I just like I don't think that's really something that I'd enjoy or something that I'd be really super good at. So I just focus on what I'm good at, and I just use that money to fund the long-term stuff. It's just like it's just easier that way. It works better for my existence.
Right, right, 100%.
So yeah, I think we would probably wrap it up there. Probably not over an hour now.
Awesome. Sounds good, brother. All right, listeners, thank you for joining us. Yeah, next week we're going to be talking about investing. So, Caitlin, any last words?
No, I think we covered a lot of good stuff. To be honest, like I'd recommend a lot of people maybe rewatch the first, 45 minutes or so of this when we were going over how to set up a trading strategy, because that really is just kind of like a little snapshot summary of everything that cost me a lot of money to learn. And, we built this channel to give stuff away for free and just help you guys out. So
If you could offer another resource, I don't know, like a book or something, just to get people to catch up really quick, what would you recommend?
um,
What's your favorite trading book? I know you read all the
my
time.
favorite trading book is probably, what is it? One Good Trade by Mike Bellafour.
Okay.
That's probably my favorite read. I think it's more helpful though if you've already been trading for a while, like if you're kind of already know what you're doing.
Right.
But that one was really helpful. And then my other favorite one, I think this one can help a lot of new traders as well. It's called The Daily Trading Coach by who is it? Not Jack Schwager.
That's the psychology, more the psychology.
Yeah. Brett N. Steinberger. I can't remember how to pronounce his last name. But yeah, the Daily Trading Coach, I think, is good for anybody at any level. It really is. It doesn't teach you how to trade. It teaches you the psychology of how to keep yourself from losing your mind, which is incredibly helpful.
Yeah. I think I wish we touch on that, because I think one of the biggest reasons we screw up is not because our patterns were whatever. It's because we couldn't get a handle of our emotions.
Yeah, for sure.
Yeah.
That's a huge part of it. Yeah, that's why I'd recommend that one to anyone for sure. But yeah, just take another look at the start of the video, because there's a lot of really key stuff in there, I think, and hopefully it helps you guys out. You can message either of us on Instagram if you have any questions. Like, we're always around.
Perfect.
Yeah.
All right, YouTubers, take care.